And warm welcome to everyone on the show. I very well remember when I was talking to Aditya for the panels. I think this was very exciting because we had a very nice variety of people today on the show. A topic like this is not something which is very new in terms of fitment of global portfolios or fitment of global products in investor portfolios. We in fact had somewhat similar session even yesterday. If one goes, if one go by the schedule of this particular event. But I think what is very interesting is that here we have a wide variety and very interesting variety of people. Somebody who has been the forefront of financial planning in India, and like what Aditya spoke about, the forefront of the right practices and processes, to somebody who has been, out and out a family office person by heart and by needs and everything, to Sanjay by somebody who is, as I just said, is somebody who has redefined the entire term distribution in so many ways. And I've again known him for more than 20 years, so it's something which has been great, like what Aditya spoke about for Lovaii. I mean, of course, I have also met Lovaii, way back when I moved to Bangalore. He was among the first 2 or 3 people that I had met. So it's been, a small, close-knit community here. So let me first start by saying that while we had a program somewhat similar like this yesterday, there is one important difference which we will have in our panel today. The primary focus is not building a global portfolio here, which was a topic yesterday, which was building a global investment portfolio. Here, the primary focus of the discussion is not that, but we are more talking about the allocation, because unlike the yesterday's session where hardcore typical HNI kind of framework people who were there representing this, today we have a mix of people from various walks, and so we're going to talk more in terms of how the allocations and everything should be. So let me go with very simple flow, and then I'll keep it open for open-ended discussions. The question is, why should we look at global? And should we look at this segment-wise, which is how retail look at global investing? How would an HNI look at a retail a global investing? Or how would a family office look at global investing allocations? So let me first start with Lovaii, because somebody who has actually done all these 3 in some or the other form. Lovaii, your quick views in terms of why should one look at global? And then we'll go segment-wise in terms of how do retail and HNI and everything look at. So your views, Lovaii, please.
Yeah, thanks, Apoorva. So I think quickly, the way I look at international investing is that it forms a very integral part of financial planning and asset allocation. I think over the years, we have seen people looking at debt versus equity as the only asset allocation or the starting point. I have realized that I think looking at country allocation, currency allocation, then asset class between physical, financial, and then doing debt equity is really the right way to go. So I think that's sort of my reason for global asset allocation. And I'm going to keep my answer short so that you have more time to ask questions.
That's okay. So I, in which case, wanted to roll over this question to Sanjay Bhai as well, because from a distribution standpoint, this could be a very different ballgame. So how is Sanjay Bhai looking at the international allocations for the portfolios?
So thank you, Apoorva, and thanks for the nice introduction of me, because I might be new to this wealth management forum, because we have been representing the retail of India, and we will not be any strong wealth management.
But that's the pulse of the investment, so that's all okay.
But personally, I knew Lovaii and Munish also. Yeah. But coming to the point about the importance of global portfolio in your global assets in your portfolio, I think it's becoming increasingly very, very relevant, because if you look at today, India is what, about 3% of your global GDP. So still 97% of your portfolio or the assets is lying outside India, and gradually getting some portfolio allocation to your what you call total asset is something which is becoming very, very relevant because of, let's say, country risk, geopolitical risk, political risk, or even the correlation between, let's say, emerging market and developed market. And I can tell you from the point of view of, let's say, the India's middle class, today they all have the, what do you call, the dream to send their children foreign, abroad for the higher education. And everybody wanted to go when it comes to vacation to an exotic trip for the foreign. So in that sense, also it makes sense them to have some kind of foreign assets, which can give them some kind of cushion toward the rupee depreciation. So I think it's becoming very, very increasingly important that people should start looking at the global assets. Now, how you can do that, how the advisor would be able to,
okay.
That's definitely a very big subject to be discussed.
Correct. But I'm sure Munish would have a very different outlook towards this, because when the segment that he caters to will have a very different thought process. So it would be good to hear from Munish as well.
Yeah.
Why global from your perspective, Munish?
First, thanks, Apoorva. Thanks, for making me part of the panel, and Aditya as well. And thank you for the nice words, Aditya. Most of us have done PhDs in this space since the winter of 2004, when the LRS got announced. And we've done various, discussions and, representations to RBI and all that stuff. But ultimately, it all boils down to the need of having a offshore portfolio, because asset allocation, just because it's available, you should do it. It's not the way most people do. Uh, Even in our family office space or ultra high net worth or even mass affluence, I think we just see in a very brief manner, there are two reasons of doing global investing. I think one is we call it diversification and coverage. So when I say diversification, I mean economic diversification, economic cycle diversification, currency. When I say coverage, I mean certain sectors that you can't invest into by sitting in India. I mean, as simple an example, if I just want to play oil companies, because India has an administered price mechanism, we can't invest purely in an oil company. New age businesses, future companies, tech companies, go global corporate exposures. So diversification and coverage, diversification more with the intent of risk, requires people to do this allocation. And secondly, and more importantly for I think my segment that we are in, building an alternate currency reserve becomes a very important part, because this is not only de-risking the home currency issues that we face, but you want to have exposure to a stronger currency, because currently or in future, the families that we work with may need that money either as a lump sum or as regular flows, as Sanjay also mentioned regarding the education, or sometimes even the concept of global citizenship. Many ultra high net worth, at least one member is planning, is already there, or a next gen member is a student right now and may shift. So these can be the reasons. So broadly speaking, diversification through economies, coverage of certain sectors and plays, alternate currency resource, and finally the global citizenship part is very important, at least for the ultra high net worth part. And even I think today, forget citizenship, if people travel so regularly outside, barring the 2020, I believe, you need to have a source of reserve for larger families.
Correct. So Munish, you spoke about this very nicely, that it has to be need-based, and just because it is available, it should not be there in the portfolio. Again, the suggestions towards what percentage of the portfolio should be allocated globally is also a very subjective matter from client to client. So it's not going to be a fit-all kind of a structure. Right. But still, if you were to broadly categorize for this particular session, between a very typical retail or a middle class portfolio to an HNI portfolio to a family office portfolio. Right. Again, sticking to you first, what has been your experience of the average allocation amongst the family offices, at least? An average. So again, there would be huge variations. There could be some family office which may not have any allocation. Right. But broadly, what has been the percentage allocation that you have seen towards international investments that out of your experience?
Understood. I think, Apoorva, I think it's a very pertinent question, because as you said, the need defines the actual allocation, whether you want to invest or not, and how much then depends upon various other factors beyond just the availability of the quota. Now, since 2004, and at that time I was still working in the retail and the mass affluent space, there is no one single model which can say allocate this much, because I believe if anything is allocated less than 10% in the portfolio, it doesn't even move the needle. So it becomes more of a knowledge based or education exercise for investing there. So how do you approach it? So the idea is that either are you looking for diversification or sector coverage, or you are looking for some goal based needs for that individual. Now let's take each segment very briefly. What will retail need? Retail investor won't be thinking of, I want to create a dollar asset outside. I want to create, I may or may not send my son or daughter to study abroad. So that may not be the primary need for a retail guy. So for a retail investor, diversification may be only reason. Now, as you move up one step above, say, a mass affluent, he may have a need of diversification and plus creating some reserve currencies, because I think upper middle class have more propensity to send their kids for education and they travel obviously much more. As you go into the ultra high net worth space, then the need goes into diversification, creating a reserve currency outside, and global citizenship. So I think if you look at this, the amount of money that you want to put in will differ. So for retail, anything less than 10%, as I said, has no value. But it is viable for that person to at least have 10, 15, 20%, depending on the fact that there are liquidity issues, there are taxation issues, there is reporting issues, there may be regulatory issues for that matter. Because when a scandal does break out, I mean, that's the sad part. Even if somebody held a 1,000 rupee deposit in an HSBC bank, his name also got published in the papers. So it's a reality of life. So he has to take on all that stuff. So is it viable to invest? I think that's his call. For a mass affluent, again, it's a mix of diversification and a reserve. So when I say a reserve, he may be sending X amount of money, a fixed portion of his allocation to create that reserve. So it becomes more of a goal-based exercise. So he may say out of 250,000, I may invest, say, $50,000 a year. That's his call. For ultra high net worth, it becomes very customized, Apoorva. As you said, family offices, even same brothers in the family may have very different approaches.
Very true.
So you will need to, I think we spend almost 3 months with the family, just interviewing the family members, deciding on why do we even need an offshore portfolio? Is it a social cause that, you just want to tell people I have an offshore account, because it's not the good place to be today in these days. Idea is to you plan for that family about, is there a lump sum need? Is there an education need? You want to buy an apartment outside, or you want to just create a reserve currency? And then we work backwards on the amounts and we create, as I said, anything less than 10% is only viable when you're sending out fixed amounts with a goal in mind. Then you can invest even $1, doesn't matter. But if you are diversification as the allocation, I think minimum 10% and highest depend upon your need from your local portfolio.
Correct.
And just one caution, that asset allocation in domestic and offshore don't align. So we cannot use it. So percentage of the total portfolio will differ, I think, depending on that.
Very true. Again, we all know that India is so diverse a country that for every geography, there'll be a separate subset and the mindset which will work. So I'm very sure, and Lovaii would have experienced a lot of people who would come and say that we want to create dollar assets when it comes to international investing. But somewhere in some other parts of the country, you might not have a retail who will say that, or even a middle class person will not come and say that I need dollar assets to be created as part of my international investments. Even a feeder fund route could be good enough in that sense. So, going to Lovaii in terms of what has been his experience of investors, because we all know that Bangalore has a great affinity for this tech and US corridors and all that stuff. So generally speaking, that's one market where dollar asset might be a little more acceptable thing than what Sanjay bhai would be experiencing or someone else would be experiencing in other parts. So Lovaii, your views on dollar assets as a concept, if somebody would have thought about, or how you go about advising people on that?
Yeah, so if I go back to 10 years ago, when we first sort of thought saying yes, we should have some allocation, there wasn't much availability of product available itself. So you had feeder funds, and then you had China fund, Asia fund, Europe fund, US fund. So you said, okay, let's start sort of nibbling. And to be fair, I think a lot of our sort of learning and experience also came through that route.
Correct.
Saying, okay, we started. Somewhere around 11, 12, I think we had experienced this for a couple of years. So we had actually moved the needle and got people to put more money into these feeder fund routes. And while I agree with Munish that 10% should be allocation, people were not willing to try out that sort of quantum in the beginning. And from a financial planning standpoint, we said fine, as long as you're going to agree that you will head towards 10%, chalo, let's start with 5, let's start with 4, 3, whatever you want to start with. Because you are also experiencing
Yeah, I think.
Can you hear me?
Yeah,
Okay.
Yeah, okay.
I think you lost me.
Sorry.
So what I was saying is in 2013, when that happened, currency depreciated 25% in 1 year.
Yeah.
The US market gave 25%. So everyone who was in the US feeder fund got 50% return in 1 year. Then the next year onward, it was all let's put a lot of money in that fund, and we had to sort of caution them. So over time, I think what has happened is there are two sides to it. One, yes, from an allocation standpoint, we want to sort of go to 10% plus type of allocation. But I think we go back to goals and say, okay, how much money do you need for your goals in your local sort of country and currency? And if say 95% of my assets are needed here, at least for the next 3-4 years, then I don't have scope to do more than 5% outside. And which is fine because we know that these things will keep changing. So it's a tracking mechanism. I think over time now what we have started doing is with an international broking platform, we typically end up doing ETFs, which are US, which are world, which are ex-US, which is emerging market, Europe. Then I want to go into healthcare or I want to go into some specific type of thing. But we have stuck to ETFs. We've allowed people on that platform. Yes, they can buy FANG stocks if they wish, but we are not advising on that. Yeah, you might make a lot more money on that. So they want to assign some money. We allow for that, and we do that sort of thing. That's been a sort of movement over time. And yes, I think there is a lot of learning to start saying, like Munish says, be careful. Market cap to GDP ratio in US is now all-time high of last 50 years. Do you really want to put so much money into US? But the point is that if you are at zero today and you're making a start, you can't afford not to have US. So we'll put US, but we'll say, okay, try and do maybe X-FANG and do more S&P and try and see if you can balance it in some manner. But I think that's really been our sort of journey, I would say, so far.
Very, very true.
But
I'm sure, yeah, please.
Can I just add one thing, Apoorva, the funnier side, just keeping it a bit light. We have come across some ultra high net worths who have actually planned for the next 5 years of $250,000 and actually a lot of committed it on products or other things. And if that that $250,000 limit comes, supposing it's halved tomorrow, there's an issue of over exposure as well, which is actually there in the ultra high net worth space. And
very true.
RBI also then doesn't take it very lightly if you have actually taken a leverage overseas. So on the other side of the this equation is overexposure as well. It's an issue in some cases.
No. So you're absolutely right. Even full commitment of 250K also is a challenge because, like what you said, if RBI was to reverse even a little, then you are stuck. And most of these investments which are there, which are committed in closed-ended products overseas. So then you're stuck even more.
And the reason for that
really
is
very challenging.
And the reason, Apoorva, for that is because, as Lovaii mentioned, the access to products wasn't there. So whatever products were got into India, everybody only could invest in those or the feeder funds.
Correct.
And closed-ended were brought in because there were higher fees and all that stuff. I think that's a separate talk for separate discussion.
So, but I'm sure Sanjay Bhai would be facing a very different thing. So suppose if there is a retail investor who walks up to him, the challenge would be that for a retail investor, most of these options that we are talking about are practically not possible also. If somebody walks in and say, I want to have 10 lakh rupee allocation total and now you give me some options, it will be difficult or challenging for anyone to give an international allocation there. So I mean, feeder funds are in most cases become the only route, at least for someone to begin with. What has been your experience, Sanjay Bhai? What is the kind of need which you have seen beyond feeder funds, at least in the retail segment or the middle class investor segment, if we call it?
So, Apoorva, I think I'll first of all, let me talk about the what Lovaii said. I think today we all are comfortably talking about international funds because the history of last 2-3 years has been amazing as far as return is concerned. So I think always a caveat for a retail investor is that he should not go and buy the fund just because of the return. And the allocation to international fund has to be purely a core allocator from a very long-term point of view. And he should not think about adding 1% alpha to his portfolio. I think that's the real serious advice. Otherwise, the moment you have what we talked about 2013, 14, where 1 year return has been amazing, people started investing and then again they burned the fingers and they moved out. So I think in case of a retail platform like us plays a very, very crucial role, because when the noise becomes louder, people start looking at the international funds. When the returns becomes bigger on the visibility on the screen, they'll always start saying why should not we invest into a Brazil? Why can't we look at China? Why can't we look at the FANG stocks? Why can't we look at the Nasdaq? So I think the role for, and specifically at Prudent, that's why what we have created a combo for the global asset allocation funds, and wherein we already provide the about 18 to 20% ready-made allocation to a large emerging market, large developed market funds. So we believe that when the allocation starts happening, you should first of all look at the developed market rather than emerging market. So you're already in India and you should not go and buy another emerging market. Because otherwise we all will be in the same boat. When the emerging market falls, your country will also fall, other country will also fall. So I think first diversification from a retail point of view, who is unable to do a lot of analysis, we suggest them that you look at probably a large countries like US and Europe. I think have the exposure into a diversified fund or a true global fund, which is, let's say, for example, there are a couple of good feeder funds who invest into a global based emerging opportunity funds. So you should have the funds which are purely global funds. So normal advice from our side, we provide that what you call the combo, where you can do a lump sum also. You can just start the SIP also. A 5,000 rupees SIP will give you a 20% allocation to a, let's say, one global emerging funds, which is exposing to all kind of emerging quality stocks. So that is what is advisable from a retail point of view. I think whenever somebody talks about his child education planning, keeping in mind foreign studies, we suggest 80-20 allocation for equity and debt. And within 80%, we say you keep 30% to the equity of the global equity. So 50 domestic, 30 global equity, and 20 for the debt funds. So that is the 80-20 allocation we give for so that is the probably requirement for a retail. So retail should not end up, I think if you look at, we all talk about today, right? But there are about 39 funds, and the total size of Indian mutual fund industry in the global is also about not more than 10,000 crore. So on a total 10 lakh crore of Indian equity based mutual funds, it's not even 1%. So I think this still a large part of the allocation has to be covered, but at least one positive point is we all are having the dedicated conference today on this particular topic. So I think people out of that home bias and people are ready to talk about. Now the role of an advisor or the distributor will be very, very critical to make sure that he should not burn the fingers and make it clear that this is an allocator from a very longer term point of view, not just because it is alpha to your portfolio.
Correct.
That's why I'm saying that the role, I don't think retail is asking left and right for investing into this. It is first of all, I think our 14,000 partner has to embrace that we need to give this as a product, as an allocator for those who need this. So the retail has to first of all understand the domestic equity. I think allocation to domestic equity is also, I think, increasing very, very fast. So let them be comfortable for the domestic equity first. Once their journey of investing into domestic equity is comfortable, we should invariably talk about the global equity. And that also probably a very core long-term allocation to a developed market where you knew that it's a very comfortable allocation. You will not have a huge volatility.
Correct. But one thing that you touched upon, and I would also want to highlight this, is the knowledge part of it. See, most often today, the investor, at least from an investor standpoint, when he is talking about allocations, the investor in most cases will not have the adequate knowledge for him or her to understand, what percentage allocations, where so you might take a stance that you would want to be only with, prominent developed markets and don't take much of emerging market, risk also, which is all fine. But honestly, Sanjay, we have found some very interesting conversations with investors who would have argued, and these are like very interesting arguments. In a small, and I wouldn't name because a few things will become very obvious, but in a very small town down south, we had one investor who gave a very nice argument saying that I'm looking at investing 30% of my portfolio into overseas market and preferably into certain markets like these. And when we want, in terms of how this risk factors could be. And the investor came back with a counter saying that how many people in India can understand Reliance balance sheet, but you still go out and buy Reliance. So if I take a country view, am I taking too much of risk? Now the investor is arguing whether he's taking too much of risk or not. When he wants to take a view on certain other geographies. So I think somewhere what we are finding is investors, while they do understand, most of them, that knowledge is a key, and most of the people do lack. We are seeing, at least when we talk to our partners, that the buying for international products has gone up, or international allocations have gone up significantly. The challenge is more to do with what kind of product will suit what kind of investors, and what kind of markets will suit each of these people. Now, that is something which is going to be the key. I think, and here let me start with Lovaii again. Would ETF route be the only preferred route that you would suggest, unless and until somebody is really very knowledgeable or is up the curve to be able to understand everything? Would ETF be the only universe you would look at?
No, I don't think we'd only look at ETF, but I think the advantage of ETF is something that we have to recognize, that it is extremely low cost. I think the big advantage of investing overseas as opposed to the Indian market, I mean, you really get very, very cheap managed products. And especially when you are venturing into an area where, your knowledge, irrespective of how much you read and do, you're not living the life there. So the knowledge is going to get limited. So in our case also, what happens, we get supplementary sort of input and information, because when we are doing planning for clients, where there is an allocation overseas or they have something overseas, we tend to work with local advisors in those countries, especially developed markets, so US, UK, Singapore, etc. So what happens is you get a sense of what's going on there, what type of product, etc. And then if they want to do that extra piece of, I want to buy a muni bond, I want to buy something else over there, then that is always available through an advisor. What we are trying to do is a little more passive from a point of view of, and primarily from allocation point of view, and say, let's just hedge against currency and country first and allocate money there. And as Munish mentioned, there is a whole bunch of other issues of taxation and reporting and that bunch. And there, in fact, I think that our role as intermediaries and advisors becomes much higher, because many people have done things with, and then when you tell them, so you must have included this in your tax return, you would have, no, why should I? That was done when I was there, or this was done when I was here. And then that becomes a whole big piece to solve first, before you can go ahead and say, okay, this is what I suggest you do going forward. So we're just trying to make it simple by saying ETF, because the chances of losing out, at least on account of costs, are much lower. So I'm not going to lose because there's a high expense or anything like that. So I'm reducing my risk that way. And like I said, our main objective is definitely allocation to start.
Right. So, Sanjay, your views on the ETF component, because you generally confine to the feeder fund. But what could be your next steps if you were to get into dollarized product? Would you look at ETF as the next logical segment, or would you also look at, say, fund of funds kind of structures overseas or platforms, or how would you want to expand?
Say, Apoorva, at this juncture, I think the acceptability of global fund itself has to go significantly into the retail system. So probably there will be one set of people who will always ask for investing directly into the stock. They look at managing their LRS. And I think the last couple of years, probably the entire, I think if you look at the ticket size of investments has came down significantly because of a lot of what you call the platform which are available who can offer you shares in a fraction. You can buy 1/10 of Amazon, you can buy 1/10 of, let's say, a Tesla, which stock, Amazon itself was $400 one share. वो आप उसका 10% ले सकते हैं, right? So your size itself has reduced significantly when it comes to investing directly. I think the ease of onboarding, ease of execution has also came down significantly because the platform are taking all the load on their side. So probably my belief would be, I think the next logical way has to be to align with some good quality platform who can offer the direct buying, or probably you can buy the ETF directly there. So I think these are the two better way of looking at once we are comfortable, because today I don't think it's very difficult for you to onboard some quality platform on our platform. But you should have appetite for people to invest also, right? So today, if you look at my fund bazaar, where we offer every product which is easily you can buy, but we will not try to add. Let's say it's easy to buy domestic mutual fund who has been investing into what you call the global funds, and you have plethora of options available. So that itself has to grow phenomenally. But I think days are not far where people will start talking about the additional options also, and I feel probably then next logical step would be start owning those stocks directly through some good quality platform rather than doing anything else.
With Munish, let me come to the different topic, and I'm sure this is a topic of his interest as well. Munish, how big is the due diligence risk for international investing? Very quick do's and don'ts on this segment, because it's very easy to get into the glamour of international investing. But obviously, this is only a superficial glamour in most cases. So how do you actually decipher and go into due diligence of the options that are available?
Sure. So Apoorva, if you look at the investors' psychology, they'd like to take a easy step first and then get more detailed into products. So as the gentleman mentioned, that ETF is the classic example of the first step, because you don't have to do any diligence.
Correct.
The only choice is to buy either what kind of a breadth of an index you want to buy, a 500, Russell 3000, or whatever the case may be. Now, Europe will not touch by a barge pole for different reasons, but idea is that either you have the knowledge or you have an advisor who has the knowledge. Now, what does a diligence require? Now, the breadth of products in the offshore market is massive. India may be 1/10 that size. So just talking about broadly mutual funds and say managed portfolios or managed accounts. Mutual funds, it's easier to do a diligence because you've got multiple global research platforms available to you. And as long as you have the data available to you, you can always do the diligence process. The only thing which you can't do, and which is a caution for many people, is understanding the fund manager's psyche. So, we use things like attribution of returns, doing up capture, down capture, various forms of analysis to create our domestic fund manager's profile of what works for him, what doesn't work. And as Lovaii mentioned, you're not living, you're not living outside. You don't understand the local space.
Correct.
And Sanjay also mentioned that you don't understand that country, So I think the caution for most of the people, and this can work for any kind of investor, is that if you don't understand, go with a passive kind of investment as a first step. Do your diligence for the next step, which is your managed account or mutual funds. But make sure you're not doing the next step just because it is available and somebody's trying to sell a product. Make sure that you have the wherewithal of doing it. And lastly, there are other complex products. I mean, as you go towards the areas of notes on the private market side, where absolute due diligence is required, then even if I have experience, my team has experience, you need to align with a local or a global partner. I mean, we work with our group of global multifamily offices as a joint group to provide those solutions. So the one biggest caution is that, and this has happened with us when we took some clients outside, is everybody will try to sell the products which are best revenue for them. Take the first step, ask for the most conservative portfolio, which can actually be a mix of ETF and money market fund, or even a time deposit with banks at certain points of time. So I think that's the only stuff you do. Don't just venture into other products, into even bond funds for that matter. I mean, we are at the bottom of the interest rate cycle globally. So I think that's the concern we have. And also expectations from that asset class, as both the gentlemen mentioned, because usually the pain arises when the expectations are wrong. What are you expecting? And 13 and 14, we don't want to name that one particular fund of 50% return, but whenever a fund goes out in the main media and it is touted as the new flagship, there are concerns. Something has already happened. Don't be reactive. So make sure that you understand and get yourself educated. And this is for a family office or a retail guy. We don't expect knowledge at any levels of the market, but our job is to educate that person as well.
Correct. The other thing which we keep on saying is that the moment, and this has happened across the board, the moment there is anything to talk about international investing, very soon we jump into, and the products actually come and present more on passion investments and everything. We keep on saying that keep those things away. That are not investments. These are your passion only. Let's not even call them passion investments. Free to make money, free to spend money on this. Whether to call that investment or not, where there are no regulators, where there are no benchmarks for you to measure, let's not call them as investment, because that will give a bad name to international investing per se. So let's not mix passion investments and investment is the other thing which we keep talking to people.
Yeah. If I can add just one thing, Apoorva,
please.
there. Passion investments is at the peak of the risk pyramid.
Correct.
So
absolutely.
They can make investments, and just for somebody's knowledge, people can Google it. The
Correct.
best performing asset class in some years in America has been pigs. So so you have to understand there are investments much beyond the listed side which actually make you much return. But as you rightly pointed out, you need to understand where passion ends and investment starts.
So just to quickly summarize, because we are short of time and we will take few questions now. See, we spoke about retail, HNI, family offices, all these categories as well. We also believe that when it comes to international investing, we need to categorize between certain geographies. So like we said, developed markets, developing markets, or somebody want to take a punt and there's no harm depending upon the risk profile to look at frontier markets also if they want to. There could also be strategic investment allocations or technical allocations as well. Somebody may have, and somebody who's built a reasonable portfolio can also take technical calls in between. If you are in ETF and via a platform, you can do that also for a certain percentage of the portfolio. But everything boils down to in terms of what is the fitment of that product in your portfolio and what percentage it is, and whether for that percentage you can take those kind of risks or not. So I think this is something which is the key for taking the international investments forward. Any last concluding notes, because then we'll open up for question answers for 5 minutes that we have now. Lovaii, anything from your end?
So I just equate international investing just as you would do Indian equity investing. The core portfolio is large cap, then you have a little bit of mid cap, and if you can take the risk, do small cap. I think if you think of it like that, then you say developed markets will be the largest portion, especially for people who are investing from India. And then you want now, okay, I want to do frontier, I want to do emerging, I want to get into this exotic XYZ fashion or particular stock. I think that all comes in that small cap category, the way you would allocate your Indian portfolio.
Sanjay?
No, I think probably, I believe retail investors should start looking at seriously as far as the allocation to global is concerned, but they should go in a very staggered way. It should not be based on the return. And probably we believe that it should be a part of their SIP, one of the core allocation. And from a retail and even from a middle segment also, I believe that they should look at pure diversification from a country side, from a political side. I think from a size of the GDP, from an innovation perspective, from a new technology perspective, I think US and Europe provides amazing opportunity as far as investments are concerned. Leave aside the valuation concern. I'm not talking about whether valuations are right or wrong, because that question today, US is expensive, emerging market is not expensive. It might be a reverse table some point of time. But my belief is it has to be a core allocator, and somebody should not jump the gun. Look at it as a very, very core long-term allocation. When we talk about gold as a sum allocation from a very longer-term point of view, I think this is also allocation very longer-term point of view, about 10 to 15% we believe to start with, and gradually it can go up to 15 to 20%.
So same you believe, and I completely agree. One should not look at returns when you take an allocation call. One should look at how does it diversify the risk. So it should be used from a risk diversification or an opportunity which is otherwise not available in India, which you are getting, and if it adds value to the portfolio. That second part, if it adds value to the portfolio, is very important, because if it doesn't, just because it is available, it should not be there in the portfolio, like what Munish said. We completely agree on this. Munish, last concluding notes from your end.
No, I think with the paucity of time, very briefly, I think I don't think it's an asset allocation exercise. I think the reasons for offshore investing have to be very clear, and that reasons will then define the width and the complexity of products. And I think this is only a stepping stone for making this as a viable part of the allocation. But caution persists. So unless you have a need, don't enter that space just for the heck of it.
Correct. So we have, we're done with this session. We'll take up the questions, but thank you, gentlemen. This was excellent. We did cover everything that we could within the time. And of course, this is an endless topic which could have gone for hours and hours otherwise. So first question that I'll take from Mr. Udit: for retail investors, how can one directly invest in offshore shares? And what's the verdict on fund of funds versus ETFs? So let me divide this question to let me ask Sanjay Bhai to take the first question. What's his view on directly investing in offshore shares? So and I'll ask Lovaii on the FOF versus the ETF part.
Yeah. So to be very frank, I think based on the market information I am going to share, I think I'm not an investor directly into any global equities, but I think there are a couple of good quality platforms called Stockal or the Vested or even the sponsor of this entire event, Crystal. So these are the players who have a very quality platform where you can easily onboard on them. Gone are the days where if you want to invest in, let's say, global stocks, you need to be onboarded through JP Morgan, who will say my minimum ticket size is $5 million. So I think that days is gone. So now it's really came down to a very minimal level as far as investment is concerned. And the operationally, it is very, very easy. I think there are a couple of people who has already tied up with some quality platforms. So probably buying directly into the stocks, they also offer a couple, like say there is a small case here, there are small case or the managed portfolio or defined portfolio or created portfolio is also available where you can buy all FANG stocks or you can buy NASDAQ, you can buy ETF also. So the execution investment part is very, very seamless and easy through a couple of platforms like what I talked about.
Correct. Lovaii, the usual debate of a fund of fund versus the ETF.
I think it's a question of quantum of money and, you know, in what sort of flow you're going to have that money available. So, you know, it becomes difficult if, you know, you're going to get it like Sanjay suggested, you know, and as an SIP route. Then every time I'm transferring money onto the international platform to buy the ETF, there is a cost, etc. And, you know, you worry about all those. Whereas in the fund of fund, it is sort of camouflaged in a manner. So depending on the quantum, I think smaller quantums, you can certainly start with fund of funds. Ideally, from a cost standpoint, ETF a better route, but don't get stuck. If you can't, then at least start with fund of funds, at least start the allocation.
Correct.
Yeah.
So there is one question from Jaideep. I'll quickly read this out. What is your view on the non-market related investments like real estate, whether in full or in fractional holdings if available? And this is from the global real estate angle and not the Indian angle. So while I will transfer this to Munish, let me just add one thing. Jaideep, it's important that whatever you do internationally has to be a regulated entity and in a regulated format. So just the first filter that you should have is what kind of regulations apply for anything. Just because it is available, it should be there in the portfolio. Let's avoid that part of that mindset. If it is regulated, if it is falling into the ticket size that fits in, and if it fits into the portfolio's overall frame of things, then I think it makes sense, for someone to look at. But if the portfolio size is not adequate enough, and just because it is available, there's no point in terms of giving that kind of a product to an investor. So look at this, and also one more thing which we, should look at. A lot of these products are actually meant for qualified or accredited investors, unless we are talking about pure fractional holdings. So you need to look at that, whether your investor is fitting into those international criteria of being an accredited investor. So keep all those things in mind before you suggest anything. Munish, you would want to expand on this because the larger clients would, of course, have a very different. I spoke from a retail or a mid-sized kind of client's perspective, but if you want to add anything for the larger clients.
No, I think what you said applies to everybody, Apoorva. Because ultimately whole or fractional holding is a matter of comfort and convenience.
Correct.
Your investment thesis on buying real estate, as you do in India, has to be there. Are you buying it for capital gains? You're buying it for rental values? Because multi-family apartment holdings in US, senior living or student living houses, which is more on rental and all that stuff. I think if your thesis is correct, then you should, and then you should align that, I'm getting, say, hypothetically, I'm getting a 2% yield or 2.5% or 3% yield from that particular asset. Or I believe that Manhattan property will actually go up because I'm buying at a good price. As long as your thesis is correct and you've verified it, fractional or whole is a matter of availability of capital and legal laws, as you rightly pointed out.
And ability to hold on to it. If your thesis goes wrong, I think that's an important element.
That applies to India as well. So